Imagine a 68-year-old sitting in a dimly lit restaurant, staring down at a $20 appetizer. On paper, his brokerage account holds over $2 million. His spreadsheets say he has won the financial game. His wealth advisor insists he is completely safe. Yet his pulse quickens, his jaw tightens, and he quietly decides against ordering it. To his nervous system, taking $20 out of that portfolio does not feel like buying a meal. It feels like bleeding. Just 3 tables away, another retiree orders dinner without hesitation, books a flight to visit his family, and leaves a generous tip. On paper, his total net worth is half the size. He lives in the exact same economy, faces the exact same inflation, yet experiences a completely different existence. We have spent decades worshiping the total size of the balance sheet, believing that a larger number automatically delivers peace, freedom, and sovereignty. But there's a silent, devastating chasm between wealth on paper and wealth in real life. And today, this is Moni Explained. For 40 years, modern financial culture conditions you to do one thing: accumulate. You are trained to sacrifice present gratification, endure market volatility, and protect your principal at all costs. Your brain physically rewires itself to associate adding money to the pile with safety and subtracting money with danger. Then, almost overnight, you are expected to flip a biological switch. You are told to stop accumulating and start spending down the very asset you spend your lifetime defending. But human psychology does not operate on a calendar schedule. If you're fascinated by how money, psychology, and global power really operate beneath the surface, subscribe to Moni Explained, leave a like, and share this with someone who values the truth over appearances. Now let's look closer. Here's what almost everyone gets wrong about financial independence. They assume a $2 million portfolio automatically produces $2 million worth of living. The numbers tell a completely different story. A comprehensive study analyzing actual consumer transactions across millions of bank accounts revealed a startling reality. When researchers examined households holding between $1 and $3 million in total wealth, they discovered that net worth had almost no correlation with how freely people lived. Instead, the entire outcome was dictated by structure. Households whose wealth sat almost entirely in market portfolios, with only 20 to 40% coming from guaranteed income, spent a modest median of under $50,000 a year. Every market correction felt personal. Every withdrawal registered as an existential threat. Meanwhile, households with the exact same total net worth, but who structured 60 to 80% of their wealth into guaranteed income streams, spent $72,000 annually. That is a 44% increase in real-world living on the exact same economic balance sheet. Even among households holding between $3 and $5 million, the pattern held firm. Families with guaranteed cash flow outspent their portfolio-heavy peers by 35% year after year. On the surface, it looks like success to maintain a massive, unencumbered stock portfolio. Beneath it, you are trapped by the fear of sequence of returns risk. That's where the real damage occurs. When your wealth exists entirely as a fluctuating balance on a digital screen, every withdrawal feels like irreversible depletion. You are forced to watch a shrinking capital base while trying to project 30 years into an uncertain future. Your nervous system cannot distinguish between a calculated 4% safe withdrawal rate and an assault on your long-term survival. A predictable income stream, however, acts as a psychological permission engine. We spend our entire adult lives receiving paychecks. An incoming deposit signals renewal, while a fluctuating portfolio signals fragility. When you live exclusively off a portfolio, the natural impulse is to underspend, undertravel, and overworry. Consider 2 individuals with identical $2 million foundations. The first keeps every single dollar exposed to the broad market. Mathematically, they could support $80,000 in annual spending. Psychologically, they restrict themselves to $55,000, constantly checking index charts before booking a holiday. They are prosperous on paper, but impoverished in their daily reality. The second individual converts a calculated portion of their capital into an unbreakable income floor. Their liquid portfolio is smaller, but their predictable monthly cash flow is guaranteed. Because their fundamental survival is insulated from market pullbacks, their spending permission surges. They comfortably spend $80,000 a year with complete emotional clarity. Think about what that actually costs you if you choose the wrong path. You spend 4 decades building financial freedom, only to become the anxious guardian of a spreadsheet you are terrified to touch. This exposes a fundamental flaw of modern financial planning. The industry profits by convincing you to maximize total assets under management because their fees scale with the size of your pile. But human fulfillment does not scale with assets under management. It scales with spending permission and cognitive bandwidth. Paper wealth gives you a theoretical. The greatest misconception
usable
wealth gives you daily
is
that successful investing, when you realize as a test of intelligence, cash flow, in reality, guaranteed floors are not just mathematical calculations. Modern research into sequence tools to buy freedom from fear reveals that the greatest threat to your retirement is not average 30-year largest abstract number, but the timing of market downturn, the highest quality, and after you've lived the workforce. Some people spend their entire lives first years of retirement so aggressively unprotected that they accidentally underuse or permanently deplete your principal. They finish the journey by establishing the balanced 3-fund baseline and the smallest and adjusting the equity to bond ratio as your ability, has never been about the number glowing on the screen, need to take risk changes. It is about whether that capital insulate your future self from financial catastrophe. Unpaid custodian of your own money. It does not require analyzing candlestick charts without fearing tomorrow. Fees. Thanks for watching or Moni reacting explained. To breaking financial Don't forget news. To subscribe. It requires harnessing the compounding power of the global economy, automating your investments, and reclaiming your time. Wall Street sells illusion of control because hyperactive trading generates revenue for the institution, while patient inaction builds wealth for the individual. The 3-fund portfolio does not promise overnight riches, nor does it stroke the ego of those seeking the thrill of the trade. What it provides is far more enduring, a mathematically grounded framework designed to preserve your peace of mind and protect your autonomy for a lifetime. Thanks for watching Moni Explained. Do not forget to subscribe, and I will see you in the next video.